Well, the gold rally taking a breather here following the Fed's 25-point cut on Wednesday, but Fed Chair Jerome Powell signaling no December move in his post-decision press conference, pushing yields higher and weighing on gold prices. For more, I want to bring in now Ben McMillan, Chief Investment Officer at IDX Advisors. Ben, always great to see you, especially on set. So let's talk about gold. This red-hot trade cools. First of all, why did it cool? Is that? Do you see it, Ben, like that's technical, that's macro-driven, that's both? What do you see?
Yeah, it's really technical driven, and I think it's helpful to kind of zoom out and look at what contributed to this, huge rise in gold in the first place. I think when we spoke earlier this year, it was really about central banks being the marginal buyer. And of course, they've come out since COVID, they've really upped their purchases. Believe it or not, in Q3 of this year, the demand for gold was the highest it's ever been in recorded history, 1,300 tons. And the big new buyer now was ETFs. So that's institutional buying, that's retail buying. Physical demand is huge. We're seeing lines for gold bullion in places like Costco and things like that. So my point is these are structural kind of generational tailwinds, leading gold higher and higher and higher. But when it rises that quickly, that fast, there's always going to be a technical pause, especially when we see something like interest rate expectations shift like they did yesterday.
So would you see this, Ben, as okay, this is a pause in a broader secular rally? Is that how you'd frame it?
Absolutely. So the question now is, all right, well, does this kind of a consolidation sideways? How does it trade down? If so, to what degree? So we're really looking at technicals here. We're seeing a lot of dip buying, below $4,000 an ounce, which I think is healthy and instructive. I think the big question now is really about the economy. If we see a recession, we could see gold retest, maybe 3,800, 37 down to 36. But again, you're going to see big institutional buying come in there because remember, these central banks, these institutional buyers, these physical buyers, they're buying and holding. For them, it's not a trade. It's a confidence vote on fiat.
In terms of your price ranges, here I want to put this number in front of you. Goldman Sachs, all right, here's what they're telling clients. They say they see gold hitting 4,900 by the end of next year. What do you make of that call?
I think that's very likely.
You do?
Yeah, we're on that train. We think it's probably hard to see how it doesn't hit that. We'd have to see kind of a huge spike in interest rates or something really structurally change. But again, this is part of the kind of currency debasement trade. And again, when we spoke earlier this year, it was really central banks were selling treasuries, buying gold. For the first time now, central banks actually own more gold than treasuries. But now that trade, so to speak, has kind of shifted into Main Street. And again, that's why we're seeing physical buying. So this is a generational secular trend here.
Well, sticking with central banks, though, you heard from the Fed. Now, they gave you the cut, but then Powell comes out and says, well, that December cut, that's no sure thing. Far from it, I think he said. You watched that and thought, okay, the impact on gold is what there, potentially?
Well, the near-term impact is negative. Right. Gold is competing for interest rates. But again, you look at Powell, and I think the question is, all right, to what degrees does that overwhelm kind of the structural demand shift that we're seeing? And in the near term, I think that is the risk. If we see the economy really start to slow down, that could weigh on gold. Powell, I think if you read between the lines, was kind of really concerned about inflation more than jobs. So that those will be the numbers to keep an eye on. But again, when we look at kind of the demand that's emerging for gold, and even you talk about, I think Goldman Sachs, not just their price target, but they're now starting to recommend higher allocations to gold in 60-40 portfolios. It's not dissimilar to what we saw with Bitcoin, kind of quote unquote going mainstream. Gold is reemerging as kind of the favored quote unquote alternative holding within 60-40 portfolios.
So we talked central banks in terms of geopolitics. A lot going on this week. Also, Trump and Xi. You had that meeting, first face-to-face meeting in a long time. To the extent that you see U.S.-China tensions de-escalate, Ben, the impact on gold is what? I mean, does that reduce, safe haven bid?
That probably reduces the safe haven bid a little bit. Now, again, in the context of kind of broader demand, it certainly doesn't do anything to address, the kind of fiscal and monetary deficits. But I do think that reduces the safe haven bid a little bit. I think too, the market has started to discount kind of, U.S. and China just posturing, both kind of looking for a deal. We saw this with, Trump 1.0, where he and Xi Jinping kind of, agreed on terms, shook hands, got the, the Oval Office picture, but then both sides went away and didn't really do anything. So I think the market is starting to kind of discount that rhetoric a little bit. And yeah, could that temper gold a little bit? Absolutely. I think it could potentially elongate the consolidation that we're seeing. But in terms of intermediate and longer term expectations, it's tough to see how gold's not hitting $5,000 an ounce next year.
I want to end on this because we've been talking gold, but I also want your take on silver. Let me make sure I get this right, Ben. You say silver could hit 100 by end of next year. What's driving that view?
So silver's interesting because now that's at the very top end, but silver's interesting because it has a really robust industrial use case. So it's solar, it's the electrification build out. So we've seen, AI has been kind of the dominant theme for the last year. That's spilled over into copper as part of the electrification build out, even things like uranium and nuclear. Silver is now part of that. And if you look at China's version of their big beautiful bill, a lot of that is solar build out, which is going to need physical silver. And there's a rush on physical silver right now. It's very hard to get. In fact, even in one of our funds, we're expecting to take delivery in the December contract. We're starting to trade physical because there's more paper contracts than physical, and this is similar to what we saw in the 1980s. So the silver is facing its own supply squeeze because of that physical industrial demand. But again, it's now part of this currency debasement trade that is, again, a kind of a multi-year, multi-decade uptrend.
Yeah, look at that chart. Ben, great to see you as always. Thank you, sir.
Thanks, Josh.